Sofi stock got destroyed because an analyst downgraded their stock rating. Hey there fellow investors and tech enthusiasts, welcome back to another exciting episode of our YouTube channel. Today, we'll be examining two articles, with the first one titled, Sofi stock slides following a downgrade to underperform at KBW. In case you missed it, Sofi's share price has experienced an 11.41% drop due to investor concerns triggered by a recent stock downgrade from a prominent analyst. We'll delve into the most recent price targets for the company, exploring the lowest end targets and the reasons behind the widespread apprehension. I'll also address any concerns you may have in this video, as I believe that there might be an overreaction in the market currently. If you appreciate content like this, remember to hit the like button and subscribe if you're new. You can also become a channel member for as little as 99 cents per month, supporting my presence on YouTube. With that in mind, let's dive into today's updates. For those unfamiliar, Sofi Technologies functions as a fintech company, essentially operating as a digital bank. Sofi Technologies recently experienced a significant 11.61% drop in its overall share price following an analyst's decision to downgrade the stock from a market perform rating to an underperform rating. The analyst cited concerns about the company's premium valuation as the primary reason for the downgrade. It's noteworthy that Sofi's remarkable surge of 45% over the past few months has outpaced the Nasdaq Financial Technology Index, KFTX, which only climbed 30% during the same period. This suggests that Sofi might be trading at a premium, prompting the analyst to view the share price as too high. In this video, we'll delve into the most bearish price targets and explore the fair value of Sofi stock. The analyst defended the downgrade by stating that, despite the shares being polarizing, caution is warranted when a growth stock is trading at premium valuations with a potential 15 to 20% downside to the consensus of beta. Essentially, he believes that the rapid surge in share price hasn't been matched by corresponding improvements in fundamentals, especially concerning their beta compared to market valuation. Despite the imminent profitability for the company, highlighted in our upcoming discussion, sell-side analysts anticipate further downside. It's crucial to recognize that investor reactions may be exaggerated, overlooking the company's fundamentals. When we factor in the valuation relative to their growth rate, Sofi appears to be fairly valued. I'll present data supporting this perspective shortly. Despite recent fluctuations, Sofi has shown resilience and stability in its 18-month journey, maintaining a volatile but upward trajectory. Importantly, the current stock price remains 50% below its previous highs, suggesting that the company is not currently overvalued. Considering the current recovery trajectory, Sofi's business is in a much stronger position now compared to when it reached its all-time highs. This presents an opportune moment for investors to consider acquiring Sofi stock at a lower price before Wall Street fully recognizes the company's overall strength. For those unfamiliar with Sofi, they operate as an all-digital bank through a smartphone app, distinguishing themselves with a customer-centric approach and a focus on educating customers about wealth building. Sofi strategically targets young high earners, recognizing the significance of this demographic in shaping the future economy. The company's shares are currently priced at $8.60, with optimistic analysts anticipating a surge to $15 per share. However, more conservative sell-side analysts express concerns, suggesting a potential decline to $3 over the next 12 months. This apprehension among investors has been amplified by the recent downgrade from KBW, leading to the liquidation of Sofi shares. Contrary to these concerns, the speaker remains optimistic, viewing the current share price as reasonable. Even in the event of further declines, they see it as a favorable buying opportunity. The rationale behind this perspective is rooted in Sofi's impressive growth numbers. The company, functioning not just as a bank but also as a fintech entity, has experienced a significant increase in membership, skyrocketing from 1 million in early 2020 to nearly 7 million by the third quarter of 2023. This growth trajectory underscores the company's appeal and potential for sustained success. The third quarter count for Sofi Technologies witnessed a remarkable 47% year-over-year increase, showcasing the company's robust momentum. Positioned as a fintech company with a banking license, Sofi places significant emphasis on profitability, particularly through lending activities. The company is currently on the brink of achieving profitability. In the banking sector, profitability is often tied to the ability to lend money and generate interest income. When individuals deposit money into a bank, the institution can utilize those funds to provide loans to others, earning interest on those loans. This interest income becomes a crucial revenue stream for the bank, enabling it to pay interest to depositors and attract customers. SoFi Technologies leverages this model to offer more attractive interest rates to depositors compared to traditional banks. For example, while a conventional bank might offer a modest 0.65% interest on a $10,000 deposit, SoFi Technologies has the potential to provide significantly higher returns. However, SoFi's revenue generation is not solely dependent on interest income from loans. The company also generates revenue through various fees and services. The graphical representation on the screen illustrates key financial metrics, with net interest income in purple, net income in yellow, and revenue in blue. Although net interest income may currently show a downward trend, overall company growth is expected to positively impact this metric over time. SoFi's diversified revenue streams contribute to its financial strength and potential for sustained growth. In 2022, SoFi originated $2.2 billion worth of student loans, marking a decline from $6.6 billion in 2019. However, there's an optimistic outlook for the coming years, with anticipated loan volume for student loan refinancing expected to rebound to at least $6.6 billion or more in 2023 and 2024. This resurgence in the student loan business is poised to be a significant comeback for SoFi. Moreover, management is confident that the company will achieve GAAP profitability either in the current quarter or the next. GAAP profitability, based on generally accepted accounting principles, GAAP, is considered a significant milestone. Once SoFi reaches this point, it is anticipated that numerous analysts will reconsider their stance on the company, likely leading to an increase in the overall share price. Ideally, investors would want to position themselves in the company before it achieves profitability, practicing proper risk management by not over-allocating more than a 5% initial portfolio allocation. Contrary to the views of the analyst mentioned in the first article, both the financial reporter and the speaker believe that SoFi stock is fairly priced at its current valuation. A comparison of price-to-book value ratios with industry giants like JP Morgan Chase and Bank of America supports this perspective. SoFi's ratio is at 1.8, JP Morgan at 1.6, and Bank of America at 1.03. While Bank of America has the lowest ratio, SoFi's ability to compete in the same range as these industry giants is deemed impressive. It's highlighted that the former analyst's belief in the company being overvalued lacks substantial numerical backing, as he did not provide specific figures on what the company should be worth at present. This further contributes to the argument that SoFi's current valuation is justified and potentially undervalued compared to the industry landscape. According to various metrics, SoFi Technologies appears to be reasonably valued, suggesting a trading range of approximately $7 to $9. The sell-side analysts with a $3 price target on the company may lack a solid basis for that assessment. It's crucial to consider that SoFi is outpacing the growth of larger financial institutions like Bank of America and JP Morgan. Given this faster growth trajectory, SoFi could have higher accounting ratios in the future, even surpassing those of larger banks. The anticipation of a substantial increase in student loan volume in 2024, potentially exceeding $6.6 billion, adds to SoFi's growth prospects. It's worth noting that this volume represents a return to regular levels, emphasizing the positive impact of the company's rebound in the student loan business. Comparing percentage changes over time, SoFi has demonstrated remarkable growth, with a 726.3% increase, outpacing the increases of Bank of America, 32%, and JP Morgan, 56%. For long-term investors seeking high-growth opportunities, SoFi Technologies is positioned as a leading player in the next generation of American consumers in the banking industry, particularly as the industry increasingly shifts towards digital platforms. Despite its current share price, SoFi remains an appealing choice. However, it's emphasized that the company's appeal is likely to become more widely recognized once it achieves GAAP profitability in an upcoming earnings report. This milestone is expected to prompt a shift in the perceptions of analysts and investors, potentially leading to an increase in the overall share price. The current moment could present an opportunity to buy into Sofi technologies and potentially lower your average cost basis for the company. However, it's emphasized that prudent risk management suggests not overexposing oneself beyond a 5% initial portfolio allocation to any specific company. Diversifying across various high-performing and innovative stocks, such as Sofi, Palantir, and others, is considered a sound strategy, especially for those pursuing an aggressive growth approach. Additionally, exploring ETFs like VTI, SCHD, and QQQM can provide a stable foundation for a diversified portfolio. These ETFs encompass a broader range of stocks and can contribute to risk mitigation. The speaker encourages viewers to share their thoughts on Sofi technologies, whether they believe the company is overpriced or fairly valued. Comments regarding personal price targets for the company in 2024 are also welcomed. As always, thorough research and thoughtful consideration of one's investment strategy are essential components of making informed financial decisions. Don't forget to hit like and subscribe to our channel for more updates. Thank you for joining us in this video, and we hope to see you in the next one. Happy investing!